Income Tax 2020, Schedule C, Employees Pay Expenses. Come in, relax with Income Tax 2020. Schedule C, Employees Pay Expenses. When thinking about the Schedule C, we're basically thinking about the top line of our income tax equation, remembering that we do have a separate schedule, that schedule being a Schedule C, it having then income and expenses in essence deductions, that then get down to the bottom line, in essence net income of the Schedule C, that then flows into the first or gross income line of the income tax equation, on which we then apply the above the line, below the line deductions to get down to the taxable income. We're going to be talking about employee expenses or wages expenses, payroll expenses now for a Schedule C. So if we are a Schedule C business, then we may have employees, of course. If we then have the employees, then the expenses of those employees will be reported on the Schedule C. Now, from a logistical standpoint, by the time that you're actually doing the tax preparation, and if we want to separate the tax preparation for income taxes from other taxes such as payroll taxes, then at the point in time that you're doing the income tax preparation, the payroll tax should already be having taken care of, meaning the employer, the owner of the business, the Schedule C owner should have then at that point in time recorded all the wages, issued the W-2s, recorded the 941s and the 940, which is the payroll tax returns and all that. What we do now is just simply enter the data, of course, into the tax software. Now that should be fairly straightforward if everything was entered properly. However, we might want to adjust or make sure that certain numbers are correct. For example, if we take a look at the forms, the 941s and the W3s, we can kind of match those up to the deduction that will be on the Schedule C for the wages expense and possibly payroll taxes expense. And those things should line up. If they do not line up, you can see that it could be potential for an audit to be taking place there, because the IRS will have both of those things. They'll have the information related to the payroll, and they'll have then the Schedule C, and you would think that the deduction would line up to the amount on the W-2s and W-3s and the payroll taxes. So that's something that we could then verify as we do the data input. And then just note logistically, people might then ask you questions with regards to payroll, or if someone has advice about payroll, you want to think about those things kind of separately in your mind. So when you're thinking about, should you take on payroll? Should you do payroll? Should you do bookkeeping if you're doing your own type of business? Or are those things that you want to outsource as you concentrate in on the Schedule C business, building then a network with payroll professionals, with bookkeepers, so that they can then work with you and feed you clients as you do the tax preparation component. So just keep those things in mind as we think about the payroll. You want to keep payroll kind of separate in terms of what it is. The tax is going to be separate. The data input from the tax return could include verification of the documentations, but the actual input of the data for payroll should be separate in your mind, even if you do both of those things. And keep in mind whether or not you want to process the payroll in the event that you're going to have questions about payroll. Also keep in mind the fact that people could have questions about who should be an employee versus 1099. Should I hire someone as an employee, or should I hire them basically as a contractor? And those types of questions which we've touched on in the past. Okay, so our Schedule C business, remember that the Schedule C business will affect, of course, the Schedule C. The Schedule C will then flow through to the first page of the 1040. Ultimately, the net income basically being here in our example 1040. The self-employment tax will then be applicable. Half of that self-employment tax, which is Social Security, Medicare, would then be deductible here on the first page, typically an above the line deduction. Note that this is self-employment tax, which is kind of like payroll taxes, but it's for the income of the employer, and so we're taking basically the net income from the Schedule C and applying basically the payroll taxes as if the owner was basically the employee and the owner for them. And then, of course, when they process the payroll, they will have to do payroll taxes in kind of a normal situation as basically the owner, who then took some of the payroll taxes from the employee to pay to the government, Social Security, Medicare, federal income tax, and then they matched federal income tax and Social Security on the employee wages. And then we have the adjusted gross income. We've got the standard deduction here, and then possibly the qualified business income deduction. We're going to be focusing in on the Schedule C. Here's a Schedule C form, a practice form here. The expense column is, of course, where we're going to be focusing in on. We're focusing in on the employee wages, which may be here on line 26. So again, note if you have a well-done set of books, then these numbers should be in there already on the actual income statement, and you should just be able to do the data input at that point. But you might want to verify them again, getting the 941s, checking against the 941s. And those would be in the payroll tax forms and possibly the W-3, which is a summary of all the W-2s, to see that the amount of the deduction lines up to what is being reported on the payroll tax side of things. Now, note as we go forward, although the Schedule C for 2020 is out, we're looking at a lot of this information for the tax guide for small businesses, which is currently at 2019 out. So we may have made some adjustments, but notice that the bulk of it is coming from the 2019 information. So most of the information should flow forward for 2020 that we'll be covering. And again, we might have made some adjustments for it. But remember that when you look this up for yourself, you can find it on the IRS website. We might provide a link, but you can find it on irs.gov. The 2020 information should be out shortly. So we have the employees' pay. You generally can deduct on Schedule C the pay you give your employees for the services they perform for business. The pay may be in cash, property, or services. So obviously when you pay the employees, that's going to be part of a business expense. You have the employees in order to help you to generate revenue. It's an ordinary and necessary type of expense, and therefore you would think, and it would be deductible. So to be deductible, your employees' pay must be an ordinary and necessary expense, and you must pay or incur it in the tax year. So those are going to be the standard kind of requirements. It's ordinary and necessary business expense. Payroll will typically fall into that category and therefore be deductible. In addition, the pay must meet both the following tests. The pay must be reasonable. The pay must be for services performed. So obviously, this would typically be the case in a normal business setting. You hired somebody, you negotiated the pay. The fact that it's a market transaction means that it would be reasonable, you would think, and it would be for the services that have been done. That's what payroll means. Why do you even need this in the code? Because it's possible that you hire someone like family members or something like that, and people are trying to manipulate the amount of deductions, possibly paying someone wages that are unreasonable in order to get a deduction when they're really like paying trying to give money to their nephew or something or something like that. So when you get family members that are involved who have incentives to give money other than market transactions to others, and take deductions for them or something like that, that's when these kind of laws or rules come into place. If it's a normal employee, then obviously you would think it would be a market transaction, and therefore they would hire the best person possible, and the pay would therefore be reasonable because they would negotiate the pay under the market, and they would be doing it for performance. So you cannot deduct your own salary or any personal withdrawals and you make from your business. So we're not talking about our own salary on the Schedule C, because typically on a Schedule C, what will happen is whatever is left, meaning the net income, is basically kind of treated in a similar way in that we have to pay Social Security and Medicare self-employment taxes on it. So the way the Schedule C works is that we don't pay ourselves wages. If you have an S corporation, then it may be a situation where even if you're a single member or a single owner S corporation, you might end up paying yourself for reasons that we won't get into a lot of detail here. But if the Schedule C business, you don't typically pay yourself. The net income, however, is treated kind of like wages in that, once again, you have to pay basically payroll taxes, Social Security, and Medicare on that net pay. As a sole proprietor, you are not an employee of the business. So again, they're saying you're not an employee who must pay yourself W-2 wages. However, they do kind of treat the net income basically as if you're an employee and employer applying the Social Security and Medicare taxes. In other words, you do owe payroll taxes, which are treated kind of similar to you being an employee, but you don't pay yourself W-2 wages. So kinds of pay. Some of the ways you may provide pay to your employees are listed below. For an explanation of each of these items, you can see Chapter 2 in Publication 535. So these are things that are probably going beyond what we would do for simple data input, But these are things that people might ask you about in terms of what is pay, what are wages. Once you're doing the tax preparation, this should already have been taken care of. It should already be on the W-2s and the W-3s and so on. But again, they might ask you questions about what could be included in those items. So awards, bonuses, education expenses, fringe benefits, loans or advances, you do not expect the employee to repay if they are for personal service activity performed. Property you transfer to the employee as payment for services, reimbursement for employee benefit expenses, sick pay, and vacation pay. So these are different types of pay, and there might be different rules in terms of the taxability of them or how you're going to report them basically on a W-2. But just note these are, kind of forms of compensation that you would have. Then we have the fringe benefits. A fringe benefit is a form of pay for the performance of services. The following are examples of fringe benefits. So again, fringe benefits are a form of pay. There may be, tax treatment for it where you wouldn't have to include them in income, although they're a form of pay. And those are the things that, of course, both benefit the employer and the employee. And those are the things that, as a tax preparer, you might be able to kind of point out as you start doing the tax preparation to see if they can work with their employer or work with their employees to offer possibly fringe benefits. Because on both sides, if you're able to give your employee money that they're not paying taxes on, then that means that your money, your pay that's going to them is going further. And that means you're basically paying them more because you're giving them money that they don't have to give away to the government. And therefore, it goes further. So it's a benefit on both sides. It's not just a benefit for the employee. The employer, by providing the fringe benefits, is providing, benefit to the employee higher than they possibly could with just a cash payment, due to the fact that, again, the government doesn't step in and take some of it. So we have benefits under the Qualified Employee Benefit Program, meals and lodging possibly, the use of a car possibly, flights on airplanes possibly. And again, this would be dependent on the type of business that we have. So obviously, if you're in the airline business, flights on the airplane could be a type of fringe benefit that, again, could be beneficial to certain employees that go, that could give you more benefit than actually cash due to the fact that it's a fringe benefit. Discounts on property and services. Employee benefit programs include the following: accident and health plans. These are some of the major kind of benefit programs that an employer can provide. Once again, providing the employee with something that gives a tax benefit, allowing, a larger benefit at less cost to the employer, basically increasing the pay by removing the taxes on it. So anytime you can do that legally, that would be good for, again, both sides of the negotiation. So adoption assistance, cafeteria plans, dependent care assistance, educational assistance, group term life insurance coverage, welfare benefit funds. So some of these things, you might be able to kind of point out, like if you notice someone is going to school, they've got education expenses or something like that, or their health care and whatnot, or if they have, dependent, you might be able to suggest these things to a business owner or even a W-2 employee to talk to their employer about, to see if they can get some of these benefits or benefit programs that might be able to be beneficial to both the employer and employee. You generally can deduct the cost of fringe benefits you provide on the, also just note that many people that you work with for taxes may have access to some of these benefits from the employer, but not fully understand why it would be a benefit to them and may not participate. They might not be participating in them. And you might ask them, encourage them to do that. And one of the big ones would be a 401k plan, of course, too, is another huge benefit that the employer can provide. If you're talking about a Schedule C business, they might not be able to do a 401k. It's too complicated. But a SEP type of plan or simple plan are types of benefits that might be able to use there. And if you're talking to a W-2 employee who has access to a 401k plan or something like that and is not utilizing it, then you may want to encourage them. It's usually good to be able to utilize it if you have the cash to do so, which is obviously often the problem. But taking advantage or participating in those benefit programs is usually a good idea on the employee side. And the employer side, if you can set up a program, then although it costs money to set it up, it might go further in terms of the amount of benefit you could provide to the employee due to removing the government from the middle of the transaction. So you generally can deduct the cost of fringe benefits you provide on your Schedule C in whatever category the cost falls. So whatever category the cost falls, you can deduct basically the fringe benefits. For example, if you allow an employee to use a car or other property you lease, deduct the cost of the lease as a rent or lease expense. So they're using the car, you're paying the lease or rent expense. That's going to be the deduction on it. So although they're getting a benefit, they're getting like compensation, it may not be then on the W-2. They might not be reporting it on the W-2. And many people start to think, well, the box 1 of the W-2 is my wages. But that's not really true. Box 1 is the only the wages that have been included and are required to be included for federal income tax purposes. That's the wages you're being taxed on. But any benefit that you get is basically compensation. So fringe benefits are a form of compensation, may not be something you have to pay federal taxes on, and that's good. You should recognize that as a good thing. Your income is higher. And the reason it's fringe benefit is so that it's not included in box 1, so that you don't have to pay federal taxes on it. So if you own the property, include your deduction for its costs or other basis as a Section 179 deduction or depreciation deduction. So if they're using the car, then, if you pay rent, then you record the use of the car basically when you deduct the rent of the car and the 179 deduction. Or if you own the car, you would depreciate and take the 179 deduction if applicable.